In this video, we're going to talk about the best ways to use your retirement accounts. And most people have retirement accounts. They know they have a 401k. They know about the Roth IRA, but they aren't sure about the best strategies to use on these retirement accounts so that it can, one, make a lot of money for retirement, and to save a lot of that money from being taxed. Now, this gets complicated because there are many different retirement accounts. You have the 401k account, which is the most popular. You have the Roth IRA account, and then you have the traditional IRA account, and then you have the 403b, you have the 457b, you have the simple IRA, you have the solo 401k, you have the self-directed IRA, you have the SEP IRAs, you have HSAs, and we could go on. And because of all these different retirement accounts, it makes it a bit complicated, as you may be wondering, well, is my 401k good enough? And should I switch to one of these other retirement accounts? And how do I get to save on taxes or ensure that when I'm pulling money from my retirement accounts, I don't lose 50% of my money on taxes when I'm 60 or 65 years old? So that's what we're going to be talking about in this video. And by the end of this video, you should have a clear understanding of which one of these retirement accounts, or even if it's multiple accounts, which ones you should be using and how you should be using them to your advantage. Now, if you're new to the channel, my name is Eann, and on this channel, I talk about ways to make money, ways to save money, ways to invest your money, business ideas, credit cards, bank accounts, investments, and everything to do with personal finance. So if you like these videos and you like these types of topics, be sure to give the video a thumbs up. I'll really appreciate it. It's 100% free to give this video a thumbs up, won't cost you anything. Also, be sure to subscribe with the notification bells on. That way you never miss the updates of when I post new videos on this channel. Now, let's talk about these retirement accounts. And to make this very simple, these retirement accounts fall under two main categories, right? So the first category is retirement accounts that require you to pay taxes up front, where you can actually put money into that retirement account. And then the second category is going to be retirement accounts that allow you to put money in them before the money gets taxed, and then you pay taxes at the end when you're actually ready to pull that money out at retirement. So either you pay the taxes now and then you put the money in the retirement account, then you can withdraw the total whenever you're ready to retire, or you put the money in before it gets taxed, and then when you retire and you want to take the money out, you can pay the taxes at that time. So those are the two main categories that retirement accounts fall under. So let's talk about the most common first, which is going to be the 401k. And this is an account that you have through your employer, where you contribute a percentage of your paycheck to your retirement investments. Here, this money is going into this investment account pre-tax, meaning that the money that goes into your 401k is not taxed before it goes there. And so at the end, you're gonna need to pay taxes when you're ready to withdraw this money at retirement. There's also another account, which is a 401k or Roth 401k. And this is where you pay taxes first and then put the money into this retirement account. With a Roth IRA, again, you pay the taxes before on this money, and then you put it inside of that retirement account. And then at the end, when you're ready to retire, you can grab all the money and you can move it because you've already satisfied your tax obligations because you paid the taxes before you invested the money. With a traditional IRA, you put the money in pre-tax, and then at the end, you can take the money out, but you're gonna have to pay taxes. So a really easy way to remember this is the ones that have the word Roth on them. These are the ones that pay you, or you pay the tax up front and then you put the money in, and the ones without Roth are the ones where you put the money in, and then at the end, when you're ready to withdraw, you'll have to pay the taxes. So now that we've covered what the different retirement accounts are, the most popular ones, let's talk about how you should use these retirement accounts, or how you should contribute to them. Now, even before we go there, let me just say that the worst thing that you could do is to retire with absolutely no money, or retire not knowing that you need money and then you run out of money while you're in your retirement years. And this is why it is a very important topic and you need to plan this very, very well. So here's what I would do, right? I would take advantage of that 401k that you get. And by the way, this is what I'm actually doing. So I'm telling you guys the same thing that I'm doing. So just in case you wanted to know. And so I would take the 401k from your employer And the good thing about the 401k plans is that your employer is going to match your contributions. Now, depending on who you work for, they may match up to 4%, 6%, even up to 9%. It all depends on the company or your employer, but basically they're giving you free money if you take part in this 401k plan. So you put some money in and they'll put some money in as well. But if you put no money in, then they're not going to put any money in. So I would suggest that you put at least whatever it is that they're going to match. So if they're going to match 10% off your annual income, then put at least 10% in and then let them put the other 10%, which is free money for you. And that way you end up with 20% in this case off your annual salary being invested in your 401k while you're only taking 10% from your pocket. Again, this is free money, so you should take advantage of it no matter how small the match is. Now, after taking advantage of the 401k plan, I will then open a second retirement account on my own, which would be a Roth IRA or even a traditional IRA. Now, I would actually go with the Roth because with the Roth, you make the contributions now, you pay the taxes right now, and then at the end, you can take the entire sum without paying any taxes. However, there is one limitation with the Roth IRA that I need to point out right here, and this is that for you to be eligible to contribute to a Roth IRA, you need to be making less than $129,000 per year. So if you're making less than that, then you can go ahead and contribute to this Roth IRA. However, if you're making $150,000 or $200,000 per year, then you will have to contribute to a traditional IRA instead. And actually, if you're married and filing as a couple, then this can go up to $214,000. But if you're making more than that, then you won't be eligible to open a Roth IRA account. Now, with the Roth IRA, you can contribute $6,000 per year, and that is the max if you're under the age of 50. If you're over the age of 50 years, then you're allowed to make an additional contribution, which is $1,000. So you can do a total of $7,000 per year. So that is also another limitation to consider. And this is why you should take advantage of the 401k account and also the Roth IRA. So if you were making, let's say, $80,000 or $90,000 per year, then it would be good to take advantage of both accounts because that way you get to invest more than just $6,000 per year in your retirement account. Now, I really like the Roth IRA because if you're the average person, it's going to help you to become a millionaire by the time you retire. So if you start this at age 30 and you contribute the full $6,000 in the first year, and you contribute $6,000 every single year for 30 years, and you get the average return of 10%. At the end of these 30 years, or when you're 60 years old, you will have over $1 million invested, and that money is completely yours because you paid the taxes up front. Now, if you were to invest in, let's say, the traditional IRA, then you'd be paying anywhere between 24 to 36% in taxes on average, and that would be taken from this $1 million investment that you have, which means you'd end up paying a couple $100,000 in taxes. Now, with the 401k plan, it's a bit different because you can contribute a lot more. You can contribute up to $20,500 per year. If you're over the age of 50, they have an additional catch-up contribution, which is currently $6,500 that you can add, making it a total of $27,000 per year if you're over the age of 50. So again, if you're the average working person, you could put $20,500 in this 401k per year. You could also put $6,000 in the Roth IRA per year. Now remember, the 401k is where you contribute pre-tax dollars, so you will pay taxes at the end, but most companies will allow you to do a Roth 401k. So I would do the Roth 401k, and that way you get the taxes out the way now. And when you're ready to actually withdraw this money in the future, you don't have to pay any taxes. And you may be saying, well, Ian, if I pay taxes now, that means I have less money to invest. So why don't I just invest the money pre-tax? That way I invest more money now, and more money now has more time to compound and make me even more money. So I end up with a lot more money in the end. Now that is actually a good point. But the thing is that most people have lower paying jobs in their early working years. So if you're 25, 30, 35 years old and you're working at McDonald's, for example, you get paid $11 per hour, then you're in a very low tax bracket. However, when you get to the age of 50, now you have your dream job. You're the CFO of a Fortune 500 company, and now you're making $500,000 per year. You're in one of the highest tax brackets. And so now when you retire, that retirement account is going to be taxed at that high tax bracket that you're in, and all the contributions that you made in your 20s, in your 30s, and possibly even in your 40s are going to now be taxed at that high tax bracket. So because we're assuming that in the future you're going to have either a better job or a better business, and you're going to be making a lot more money than you're currently making right now, it would be wiser or smarter to pay the taxes now so you don't have a massive tax bill, because the taxes that you pay now are going to be a lot less when compared to the taxes that you pay at the end of your working years. Now, this is not financial advice, just my opinion, so keep that in mind and do your own research as well to find out exactly which one of these retirement plans is best for you. Now, it's also recommended that you invest at least 10% of your income to your retirement account, and depending on if you want to retire early, you may want to bump that up a bit. So if you want to retire before the age of 60, you could probably increase that to 15 or even 20%. And this is why a side hustle or side gig is really important, because you can use your day job to take care of your living expenses and live, and then you can use all the money from your side hustle to add to your retirement account. So even if you have a side hustle and it's just making you $1,000 per month, it may not seem like a lot, but adding up an extra $1,000 per month to your retirement account is going to go a far way in 20 to 30 years from now. In fact, if we look at the investment calculator, remember we spoke about the Roth IRA, you can start it at the age of 30 years old with $6,000. You put $6,000 in there every year, and in 30 years you'll have over $1 million tax-free. If you were to bump this up to $7,000, just adding $1,000 more per month, that is going to create an additional $270,000 for you by the time that you get to retirement. Now, it doesn't seem like a lot of money right now, but if you put all the extra cash you can towards your retirement account, it will actually go a far way. Now, let's talk about withdrawals, right? So for the Roth IRA and the Roth 401k accounts, you can actually pull the money out before 60. You can pull the money once you get to 59 and a half. And again, you'll get the money fully tax-free. Now, if you grow this to enough money, it would be recommended that instead of pulling all the money out at once, you pull about 4 to 6% per year, which should give you the equivalent of about 1 year's salary, and then that money stays in the retirement account with you pulling only 4 to 6% every year, and that way the money keeps compounding. So even though you're pulling 4 to 6% every year you're also growing this money by another 4 to 6%, because you can get the average returns of around 12% on this retirement account. Now, if you want to look this up, this is actually called the 4% rule. This isn't something I just came up with. It's a very popular retirement strategy. So you guys can look this up, and I think I have a video explaining what the 4% rule is. And short explanation here, it's just a way to essentially withdraw from your retirement account every single year. And even though you keep taking money out, that retirement account keeps growing instead of it getting less. Now, if you go with a regular 401k or even the traditional IRA, you can start withdrawing at 59 and a half, but the only difference here is that when you're ready to withdraw, you're gonna have to pay the taxes. However, there is one thing that you can do. There's something called a backdoor where you can invest in the traditional IRA. Let's say you make too much money, and then you can get it into the Roth, and that way you can take care of the taxes up front. And I'll actually make a video on that as well. So if you're the average person, this is how you can use these retirement accounts, or that is the best way, in my opinion, to use these retirement accounts to get yourself to financial freedom, or most importantly, ensure that you get to the age of retirement and you're not, one, completely broke, or you have no money, or secondly, you don't have enough money because you never planned for it, and now you're only going to be able to survive for 1 or 2 years. So let me know if you like my idea of the best ways to use retirement accounts. If this is not how you do it or how you planned it out, comment below, let me know what your strategy is. And with that said, thank you guys so much for watching. All the best with your investments and your retirement savings, and I will see you guys very soon in the next one.